All right. Hello, everybody. Thank you for joining us. I'm Tyler Gill. I'm the relationship manager for Entruity Wealth, and I'm joined here by Andrew Barnes. And before we get started, just some quick housekeeping. Feel free to ask questions along the way. We'll do our best to get through all of them and get everything answered to the best of our abilities. But yeah, we'll get going. I'll turn it over to Andrew here. We got this webinar. It's going to be about tariffs, trying to understand them a bit more, see what they're all about, and maybe shine a different light on them than what we're probably used to seeing. So, Andrew, go for it.
I will take it away. Thank you, everyone, for joining today. Appreciate you choosing to spend some time with us today. Like Tyler was saying, we want to talk about tariffs and the economic and investment implications. So we'll just go ahead. First, I have the disclaimer. So I'll let you all peruse that at your leisure, and then we'll go ahead and continue here. So, probably the first thing I think of when I think of tariffs is there seems to be a headline just about every day saying how, some policy that we thought was going to go into force is either being tweaked or changed or not happening. And so, April 2nd, the Trump administration announces the tariffs on Liberation Day. And then it seems like every few days, there's just some change. And today, in fact, just this morning, looks like perhaps we're lowering tariffs on China. And the market liked that at the open. I didn't see what it was doing before we hopped on, but it was kind of coming a little down last I checked. So, there's enough changes here to make someone's head spin, and trying to make sense of it all can be a bit of a challenge. But we're going to try to do our best today. So, when Trump has mentioned tariffs, he's talked about kind of four different goals or motivations that drive him to want to implement tariffs. And the first one is decoupling. And, we'll define that as the shift of supply chains to reduce reliance on certain countries. And he's mentioned that this is a national security issue. In his view, he wants what the US needs to be made in the US as much as possible and to not rely on other countries. And so the impacts of this motivation, would be high. A lot of supply chains would need to be adjusted, and the impact would be, persistent, or perhaps another word is long term. And I think the country that would be most impacted by this would be China. And the industries you can see listed: tech, energy, industrials, pharma, biotech. And so that's one kind of goal that he's mentioned. Second one is rebalancing. And the goal there is to reduce the trade deficit and boost domestic production. He mentions bringing jobs back. And so the impacts here, perhaps not as shocking as a decoupling, but still, shifts to the supply chain. It would be persistent. And the countries being targeted here are listed: China, EU, Japan, South Korea, Vietnam, India, Mexico, Canada, and Brazil. And the industries affected are listed as well. A third goal, and it kind of seems to me that this is his top priority just because of all the changes. It's hard to implement changes to a supply chain in a few days, but it's easy to negotiate based on potential tariffs over a few days. And so this third point is negotiation, or negotiating, using economic pressure to achieve policy outcomes. To me, I don't have any insight more than anyone else, but this seems to be what Trump, or the Trump administration as a whole, is doing. And so the potential impacts here are low and temporary. If you don't give us what we want, we're going to do X, Y, and Z. And if you do, we're not, kind of a thing. The countries here affected: China, Mexico, Canada, EU, Japan, and Latin America. And these are the industries listed here that could be affected. And lastly, he has mentioned forming the ERS, the External Revenue Service, and he's talked about tariffs as a revenue source to fund the budget, and specifically, turn around the budget deficit. So if the goal is to generate revenue, then the impact would be high and persistent, because we're really, if it's there to collect revenue, we're probably not going to change it all too much. Countries, may be broadly applied to all countries, all imports into the US, and the industries affected here: consumer goods, autos, industrials. And we would see price changes and, perhaps companies' margins decreasing across industries. So when Trump talks about tariffs, these are kind of the four buckets or areas that he's talked about. And so I think it's interesting to see them all on one slide. And to me, negotiating seems to be what's happening. But again, I'm not privy to any information that we all, don't have in the public. So next, let's talk about why the US trade deficit is so high. So if there's a number that you remember from this webinar that I'd like you to remember anyways, it's that in 2024, Americans bought 1.1 trillion more than we produced. So that difference came from imports. And because of imports, the US dollar has been strong. And really, the US has been importing. We've been running a trade deficit, which means we've been importing more than we've been exporting every year since the 1970s. And so economists agree that the US importing more than it exports is a sign of strength. Our consumers are buying. But that 1.1 trillion figure is what Trump is targeting. So other countries rely on global trade or importing to us far more than the United States. And the Trump administration aims to leverage America's economic position as a tool to achieve a more balanced relationship with its partners. And so I think, I heard on Bloomberg, I like to watch Bloomberg News, that Trump was considering raising the cost of, a membership at Mar-a-Lago. I think it's currently $700,000, and he wants to bump it up to $1 million a year. And the reason why is, if you want access to the members of Mar-a-Lago, you should pay for it. And I think he has the same view as the US consumer. If you want to sell your product to the US consumer, which is my understanding is the biggest consumer in the world, then you should pay for it. And so, again, I just think this trade deficit, 1.1 trillion, he views that as a pretty big carrot to get these other countries to kind of perhaps play more fair in his view. Let's continue on here. So a major question, if I can skip ahead, is, do tariffs cause inflation? And the short answer is yes, but the long answer is it's complicated. And so, if we have one of these situations where it's a one-time tariff, prices would likely increase modestly, but then even out over time. Where it kind of gets unknown a little bit is a trade war scenario. So a scenario like that would look like we impose a tariff, and then the country imposes a tariff, and then we impose a higher tariff. So over time, the tariffs keep ratcheting up. So there are price adjustments, going higher and higher as that trade war progresses. Um, I have on the screen a chart of the Trump's first term, and he applied a tariff on washing machines. And so the blue line is what the retailers paid for the washing machine, and the gray line is what the consumers paid. And so you can see when the tariffs were implemented, the cost for retailers went up, cost them more to stock the washing machine. But then the consumer price really didn't, it started climbing maybe a few months later, maybe 3 months later. And then ultimately, from January of 2017 to the end of 2019, the prices were pretty much the same. So that's that, one-time tariff scenario, but a more worrisome scenario could be a trade war. And so it kind of looked like most countries did not want to get into a trade war, but China kind of seems to be the wild card. And that news today about potentially decreasing tariffs on China, I think the Trump administration is trying to navigate this in such a way where obviously they get what they want with the least damage as possible. So, the grade is not out yet. We don't know if it's going to be a trade war with China, but hopefully it's not. So let's see. So this next point, what is trade reciprocity and how will it unfold? So at face value, trade reciprocity is if you charge us a tariff, we're going to charge you the same tariff. It's going to be equal. And the Trump administration aims to rebalance tariffs between the US and other countries to make them reciprocal. Such a move bucks 75 years of multilateral US trade policy and sidesteps rules of the World Trade Organization, which is the successor to the General Agreement on Tariffs and Trade of 1947. So the administration is, changing this strategy because it believes the balance has tipped too far as key American industries face steep barriers to selling their products abroad. And kind of a classic example of that is autos. If we want to sell a vehicle in the EU, they charge us 10%. So our car prices in the EU are 10% higher than cars made there. But if Europe wants to send a car to us, we charge them 2.5. So Trump's idea of trade reciprocity is, why don't we make everything equal? And tariffs on major trading partners such as China, the EU, Canada, and Mexico could reduce US trade deficits and boost domestic production by giving local firms an edge over imports. But they could also invite retaliation. And an example of that would be Canada's removal of US liquor from its shelves. China could ban critical mineral exports to the US, could decrease purchases of airplanes and agriculture products, and increase investigations of US-based companies with exposure to China, such as Apple, Starbucks, and Tesla. So again, we don't really know the outcome, but we can kind of see how the Trump administration is. We can see the evidence for what they're doing, even though we don't know the outcome. So I think probably the main reason you're all here is, how do tariffs affect the stock market? And I don't know about you, but I feel like we're in 2018 again. Didn't we just see this movie? And so the first Trump administration's tariffs on China sparked a trade war that whipsawed markets and dominated the news. kind of like what we're seeing today.
Mm-hmm.
And how did the markets respond? Well, in 2018, volatility rose, driven by the trade war and a slowdown in China's economy, and it caused the S&P 500 index to fall 4.4% in 2018. But the index recovered sharply in 2019, up 31.1%, as trade deals were announced and consumer spending remained steady. In both years, inflation was muted in the aggregate, with the annual consumer price index ranging from 1.5% to 2.85%. So I think the lesson here is that in times like these, it's important to be clear about what we do know and what we don't know. And we need to recognize that tariffs are just one point, or one part rather, of a extremely complicated equation. Ultimately, the US stock market has proven to be remarkably resilient over time, and focusing on investment principles such as diversification and staying invested in the face of market volatility becomes more essential to achieving long-term investment goals. So really, the takeaway here is, you know, even though we might not know the cause of volatility, we can always expect that there will be volatility, and it's time in the market, and it's not timing the market. And so the next slide here, I have some takeaways. First is tariffs are used to help protect domestic industries, among other purposes. And so we need to, keep in mind the four motivations for tariffs: the decoupling, rebalancing, negotiation, and funding. Trump aims to lower the US trade deficit, which is near the record high. Again, that's that 1.1 trillion in 2024. And the US administration seeks to leverage America's economic position for a more balanced trade relationship. Third point is tariffs raise prices initially, but the overall impact to inflation is complex. So price increases tend to stabilize after the initial increase, unless a trade war erupts. The administration plans to adjust trade barriers to make them reciprocal. Similar tariff rates between countries can benefit domestic companies, but could trigger retaliatory actions. And I think we've been seeing that. I think there's been some retaliatory actions, but also many companies have gone to zero tariffs in response to this. At least that's my understanding. And it seems to change every day. Tariffs can increase volatility, but markets have shown resilience over time. And like we just mentioned, during Trump's first term, he announced tariffs in 2018. Market was down 4.4% for the year, but then the next year was a great year. And so staying invested to capture the rebound is something that needs to be top of mind whenever markets get a little choppy. So that's all I had for us today. Tyler, do you know if we had any questions come in?
I'm not seeing anything coming up.
Okay.
Nothing's
Well,
popped up.
if there are any questions, let's get those questions in now, and if not, we'll let you all continue on with your day.
Yeah, if you ever have questions or concerns, by all means, you can give us a call. You can shoot us an email. You can even text us, and
You
we'll
can text. Yeah, the office.
do everything we can to get back with you and try to put your mind at ease. And
I am getting a message, Tyler, that the chat is disabled.
the chat is disabled.
I don't know how to enable it. Oh, so excuse us for our tech issues, but if you do have any questions, please just give us an email. My email is listed there, or you could email hello@entruity.com. And I promise for future webinars, we will figure out how to enable the chat.
We'll get that sorted out for sure.
Yes.
Yeah.
All right. Well, I think we'll end it here. Any questions, please let us know, and we'll look forward to seeing you all at the next webinar. Thank you
Yeah.
for joining us.
Thank you, everyone.